Welcome back to Part 2 of Utilizing and Capitalizing on Retirement Assets under the CARES Act, Part 2. This is Larry Divers, and what I've done in this PowerPoint is a little bit different than in the last. As we mentioned last time around, the CARES Act, which is the Coronavirus Aid, Relief, Economic, and Security Act, did a number of things, but prior to this, the Secure Act was passed in front of that. And the Secure Act had a lot of influences on the CARE Act, and we'd have to integrate the two moving forward as we go into these very unique times. So what we started talking about last time was that extraordinary times causes clients to need access to cash for a number of essentials that they might need. So this continuation is we're going to talk about the required minimum distributions moving prospectively. Then we're going to be talking about the loan extensions and how we might use those as well. And then thirdly, we're going to talk about the distributions in general and relating them back to the required minimum distributions and distributions from trusts, etc. So with that, first and foremost, all required minimum distributions are waived in 2020 under the CARE Act. Now, a person who does and has been taking required minimum distributions can actually stop them if they want. Now, that might have a positive tax impact on them, but under the CARE Act, they can do that. Trusts can also do that if they wish at this point in time. So that's a unique thing that has gone into place as a result of this entire act. But the Secure Act changed the minimum distribution rules for both defined contribution plans, 401ks, profit-sharing plans, employee stock ownership plans, 403Bs, and IRAs. Now, we used to know that a person had to start their required minimum distribution no later than 4/1 of the year following the year they turn age 70 and a half. Now, there was an exception to that if the person was still working for the company, that they didn't have to start their required minimum distribution as long as they were not greater than a 5% owner. And what we would do is we would take their 1231 account balance and then divide it into that their life expectancy. Well, under this CARE Act, the new rule said it changed the age from 70 and a half to age 72 under Section 414 of the Act. So now all participants in 401ks, 403Bs, and similar types of plans, but non-IRA-based plans, will be able to delay their RMDs to a later date. Now, as long as that individual is not a 5% owner, they can also delay it past age 72 as long as they're not that 5% owner. So they'll then have to take a timely distribution during the year they turn age 72, and they may extend it to 4/1 of the year they follow the year they turn 72. But in that second year, they would have to take a second required minimum distribution for that year. So that's why that's changed. So it looks a little bit different. And it impacts IRA owners born after June 30th of 1949. So if they turned 70 and a half last year and were required in the first 6 months, if they turned 70 and a half, they would have to take the required minimum distribution in 2020. If they did in fact delay that up until their tax filing time, which all tax filing could be waived until July 15th, and they could roll it back into their qualified retirement plan or IRA. If they had not taken it within a 60-day period, they can still do it. But prospectively now, that means we have a year that there will be no required minimum distributions in 2020. So let's take an example. Kevin's a single IRA owner, is turning 7.5 on August 21 of 2020. Under the old rule, he would have begun taking his RMD for the year 2020 using the uniform table. He'd look it up under publication 590 and take his 1231 account balance as of 2019 and divide the factor into it. As of the Secure Act, Kevin now will not have to begin taking that until 2022. So they don't have to take it now when he will reach age 72. And then he will again use the uniform table, still under publication 590, and take the 1231 2021 balance at that point in time. And hopefully the markets have come back. So the Secure Act, the new RMD and starting date for qualified charitable deductions, though, did not change. So that's a confusion in the marketplace at the present time. The law made no changes for qualified charitable deductions. It still remains at age 7.5 when an individual can commence making those contributions directly from the IRA or the qualified plan directly to the charitable organization. Now, what that will do effectively, depending on the market, is that they will be able to reduce their required minimum distribution moving prospectively by that $100,000 amount. Now, the next thing is what really was the big change that we have to be aware of in 2020 this year is the RMD date change and how that interacts with the CARE Act. The old RMD rules were different, that the date of the account owner's death does not eliminate RMDs, but rather the manner the assets must be distributed is changed, and that's the big deal. And so the difference is if the owner dies before the required minimum beginning date, or if the owner dies after the required minimum beginning date. And remember, there is no required beginning date this year at all. So all deaths are off the table. But the unique thing is that you need to talk to clients about is they change definitions of beneficiaries under the Secure Act, which is overlapping the CARE Act at the same time. So under the Secure Act, they created this eligible designated beneficiary that went into effect 1/1 of 2020. So the surviving spouse is considered an eligible beneficiary. And then it created 4 others that we're going to talk about individually. Disabled individuals, beneficiaries, and please note this, not more than 10 years younger than the IRA or owner or the participant of the plan, or a minor child of the account holder, and they can hold it until the age of majority of the minor child, all right, but they are called out not grandchildren as a minor child. So they are called out separately in the new law. Then they created what is considered a non-eligible beneficiary. And that's a unique thing, is that they said anyone who is a non-spouse and therefore see through trust and charities, etc. And they are now under a 10-year rule, which we're going to talk about uniquely here. So the 10-year rule, in essence, is doing away with all stretch IRAs and stretch programs coming out of qualified retirement plans and IRAs. But the unique thing, if there is a non-designated beneficiary, they still follow under the old rules that if there is death before the required beginning date, they fall under the 5-year rule that they need to be zeroed out. And that includes estates and charities and non-see-through trusts. So this really puts a curveball in our planning process. So the new ones that are in here now is the spouse of the decedent. They may then stretch it over their life expectancy or treat it as their own and roll it into their own IRA and then name their own beneficiaries from there. But they would then, their beneficiaries would fall under the 10-year rule. Domestic partners do not count. Same-sex partners do in fact count if in fact they are legally married. Also then, this designated beneficiary that doesn't fall under the 10-year rule is a disabled individual as defined under the Internal Revenue Code 72M7, which in essence is total disability. The third category are chronically ill individuals. So the Secure Act states it must be reasonably expected that this is lengthy in nature and there will not in fact be a cure for a chronically ill individual, which kind of laps over to the CARE Act if there is anything that carries over as an illness. And fourth, individuals who are not more than 10 years younger than the decedent. And as I said, this by definition excludes grandchildren, but it could be parents, unmarried parents, or unmarried partners, or siblings that could fall under this regulation. And then finally, the minor child of the decedent, and that will remain in effect as an exclusion to the 10-year rule up until they reach the age of majority, and the age of majority is determined by the state within which they live in. So in essence, it could go to the age of 28 that it could be paid out for their out of the retirement plan or IRA. So with that going into the CARES Act, what happens and how does that relate to the Secure Act? Well, if we think of the new 10-year rule, I've kind of put 10 things together to think about when you're talking to a client on if they need money from the retirement assets of another individual. Spousal beneficiaries are not subject to the 10-year rule. The 10-year rule does apply to non-spouse beneficiaries when the owner dies in 2020 or later. 3, the account must be zeroed out by 12/31 of the 10th year following the year of death. 4, the 10-year rule applies to all successor beneficiaries of IRAs, qualified retirement plans. 5, there's no required minimum distribution period during that 10-year period under the new law. It can all be taken out at the end. It can be taken out in stages over the 10 years, any way that it wants to be done, but it has to be zeroed out at the end of the 10-year period. The minor children will ultimately be subject to the 10-year rule once they become the age of majority that I mentioned. Most trusts will, in fact, be subject to the 10-year rule because you can't look through to a younger beneficiary. They are locked into a 10-year time frame. Grandchildren I've mentioned a number of times, but also Roth beneficiaries, this is different, are now subject to the 10-year rule. So if you inherit a Roth IRA in one of your clients, they have to zero it out in fact, over a 10-year period. They don't have to do it immediately. They can hold to the 12/31 of the year following the year, the death of the individual, to take it out. But failure to live up to this 10-year rule can result in a 50% excise tax penalty to the individual who should have received the required minimum distribution and didn't. So that's the key change that we have going in 2000 now. All our RMDs are waived, and we're going to start all of this up effectually in 2021. Now, the loan extensions get confused with this they also are locked into a 10-year situation. In order to get a loan extension, if a qualified plan allows for a loan and the plan sponsor wishes to allow this to take place, and they would have to amend their plan no later than 12/31 of 2022, and they take it out for any one of these reasons. They're diagnosed with COVID-19, if they a spouse or dependent of a person with COVID-19, an individual who experienced adverse financial consequences as a result, and I want to be very careful that we understand this, if they in fact have been quarantined, furloughed, laid off, or have working hours reduced to the COVID-19. I've been asked by literally hundreds of people, what does that mean if it says that their salary is cut? It doesn't address that in the Act, in the CARE Act. It just is if their hours are reduced. So we don't know why they excluded it, but currently it's excluded. The beautiful one is if the individual cannot work due to the lack of child care. It can be for either individual or spouse, or for an actual individual, self-employed, who has either closed or reduced hours of business as a result of COVID-19, which pretty much impacts everybody. And anything else that the Secretary of the Treasury might want to add on to this can in fact be done for this situation. So that's the important thing. And the next thing is what it does. It changes the terms of the loan agreement. First of all, the 72P regulations increases the loan limit from $50,000 to $100,000, and that limit is reduced by the highest outstanding loan balance in the previous 12-month period. And loan payments do not have to commence on this loan until January 1 of 2021. However, the interest will accrue during the tolling period if they take it now and not pay anything on until 2021, and that will be re-amortized into the loan. All existing loans also can be extended by 1 year. So in essence, the 5-year loan program that is normally related to a 401k, 403b, 457 is now a 6-year loan program because it's extended out. And that's under the CARES Act if they need emergency funds. Similar to this, how can a client benefit from a planned loan? If we have two individuals, John and Mary Smith, both employed, both are furloughed for 4 to 6 weeks. The Smiths are concerned about meeting their financial needs for their 3 children. It's necessary. John has a 401k at work that has a vested account balance of $65,000. So he can take up to 100% of his vested account balance, or $65,000 in the loan. Mary has a $120,000 vested account balance, so she would be able to take a $100,000 loan. So they would, if need be, and it doesn't have to be done at one time, it could be spread out over a number of different loans, a total of $165,000 in loans, and have 5 years to repay it. Now, if it is for a principal residence loan, they can have it at any term that is allowed in the marketplace at the present time. So that extends that period over that. I want us to note that there is no taxation on the amounts that they withdraw. There is no 10% excise tax on the amount that they withdraw. and then they can start to reclaim that over time. So the idea of taking a loan is an important part to get across to many of their clients, but their employers have to allow it. And all the employer has to do is have a self-attestation saying that I've had this happen to the family, and you want them to write that down. There are no forms out there yet, all right, but they have to be documented. You have to have a loan agreement, and a term cannot exceed 5 years unless it's for a primary residence. Now, the next issue is that penalty-free withdrawals then can, as a hardship withdrawal, can be taken from IRAs, 401ks, and SEPs. Under the CARE Act, you cannot exceed $100,000 per person of these two linked together. You could take a $100,000 loan if you wish. You could take 0 out of IRAs. You could take $50,000 loan and $50,000 hardship withdrawal out of an IRA, but it cannot exceed $100,000 per individual. A household can take $200,000 if they have the necessary assets in their IRAs and their 401ks. It is up to the individual, not the employer, to keep track of the $100,000 limit. So these penalty-free loans rules are exactly the same as the loan rules for a person diagnosed with COVID-19, a spouse or dependent, if they have had any adverse financial consequences as a result of being quarantined, furloughed, or laid off, or having their work hours cut back, or if they're unable as a result of child care not to work, or if an individual who has had reduced hours or closed their business as a result of it, and anything else that the Secretary of the Treasury might add. So they're exactly the same as the loan requirements. So there's no 10% early withdrawal from traditionals. As we know, there's none from Roths, as well as SEP IRAs and simple IRAs. There's no mandatory 20% withholding on these withdrawals. There is an optional withholding of 10% on a W-9, which is on your withdrawal form, of up to 10% on any of these if they so wish. But all you need to do is have them sign their withdrawal form. The distributions are includable as taxable income, but the repayments may be made over a 3-year period as if it were a loan, paying it back with post-tax dollars. And we put them back in as a trust-to-trust transfer, if they so wish. But the unique thing is, for tax purposes, all right, they can be averaged over that same 3-year period for tax purposes, and they adjust it on their individual tax returns. The difference between that and a Roth is there's no income tax on the withdrawal if it is coming out of a Roth IRA, because it's all post-tax money, as long as it's principal only. If you go into the actual interest and go past the 3-year period for not paying it back, then there could be tax on it. But otherwise, right now, there is not. Right? If there were tax, it could be amortized over 3 years. So your hardship withdrawal talking points is up to $100,000 without the 10% early withdrawal. Taxes can be spread over 3 years, and money can also be paid over 3 years. Now, as we all know, anyone above the age 59 and a half can automatically take money out of a qualified retirement plan or an IRA, and no 10% penalty. They do claim them as regular income, but they also can put them back into the plan if they so wish under the CARE rules. So there's 10 basic options that you have when people need cash. The first is if they do in fact have a personal emergency fund. That would be the best place to take. The second option they have is they might want to consider withdrawing from a money market account or any other low-risk investment of which is not performing well because of the low interest rates that we're going, and not go into a stock investment since it's dropped so much. The third option is if they have a personal Roth IRA account, they can withdraw from it under the TenYear rules. And you know there are no penalties on this money whatsoever, and it's not regular income, and they can pay it back within 3 years to themselves. 4 is they can take money from their cash and borrow against their life insurance policy, which might be a good option for them if they need emergency funds. Then we talked about 401k loans if they have theirs. This is in essence if they think they're going to go back. They have a 5-year window. It's not going to go into a default as long as they make at least quarterly payments on those loans. And hopefully they don't have to do that, and we know they don't have to start it until the year 2021, next year, when they're back employed. The sixth option is they can take it from their traditional IRA, claim it as regular income, also pay it back, right, and have no 10% early withdrawal penalty on that. So then we turn to home equity lines of credit. Now with the new tax law, there are no tax deductions for a home equity line of credit, so that is not as advantageous of any one of the previous 6. If they're of the right ages, they then can, rather than sell their investments, contemplate the reverse mortgage might work for them. And if they are willing to take on more risk on their investment portfolio, the 9th option is they could in fact take out a margin loan and then pay it back. And then finally, they could use their credit cards. Now, the key thing on credit cards, some are offering 0 interest payments for up to 36 months, but they still accrue that interest during that time, and it's added back into the principal afterwards. So you have to look at each individual situation. So what we're talking is, in essence, very difficult times that we face. If people need cash, probably the best idea is take from funds from a IRA, penalty tax-free, such as a Roth, and then repay them back into them over the 3-year period, and then withdraw that money out of the low interest-paying investments, a bond, if you will, and repay it back to themselves, and as they repay it back, dollar cost back into the equity markets as we see ourselves coming out of this very serious economic problem that we're in. Hope you enjoyed the webcast today. Hope you found it beneficial, and as your clients are looking for your advice on both